Hey everyone, and welcome back to the deep dive. Today, we're really digging into some compelling financial results from Goldiam International Ltd. We're focusing on their first quarter for fiscal year 2026. Now, you might not immediately think a jewelry company's quarterly financials sound, well, thrilling, but trust us, this particular deep dive actually uncovers some really fascinating insights into market adaptation and, strategic innovation.
Exactly. What's truly illuminating here, I think, is how these numbers aren't just about one company's performance. They really reflect broader, almost seismic shifts happening in the global jewelry market, especially with the rise of lab-grown diamonds. We're going to explore how Goldiam is not just reacting to these changes, but actually kind of shaping their future within them.
Okay, so let's pull back the curtain and see what's really going on. Let's jump right into the headline figures from Goldiam International's Q1 FY26. That's the quarter ending June 30, 2025. The company announced its sales and profits were the highest ever in absolute terms for any of their first quarters, ever. That's a big claim.
It is a big claim, and the numbers seem to back it up. The sources show consolidated revenue at a pretty robust euro 2,357 million. Now, to put that in perspective, that's a significant 39% surge year-on-year compared to Q1 FY25, and even a solid 17% increase quarter-on-quarter from Q4 FY25. So this isn't just growth, it feels like it's accelerating growth.
Right, accelerating. And that robust growth isn't just on the top line, the revenue side. Their EBITDA, which is, basically their core operational profit before things like interest and taxes, that hit 471 million. That's up nearly 38% year on year and 19% quarter on quarter.
What's maybe even more impressive is that their EBITDA margin held steady at a strong 20.0%.
Yeah, and that's key, isn't it? Holding that margin while scaling up revenue and EBITDA like that. It indicates, well, strong operational efficiency.
Definitely.
And if we look at the broader financial health picture, their net profit after tax, the PTG, that's what's left for shareholders after everything. It's not even sharper increase,
Right.
reaching 336 million.
Yeah, that's a remarkable 53% jump year-on-year and a 45% surge quarter-on-quarter. And the pay-to-night margin actually improved to 14.3%. Those are genuinely impressive bottom-line results.
Very impressive. And they also highlighted a strong cash position, right? Over 784 million in cash and equivalents, including investments as of June 30th. That certainly gives them significant financial muscle.
Absolutely crucial. That strong cash position provides a solid foundation. It gives them the flexibility to invest in growth, whether that's organic expansion or even perhaps opportunistic acquisitions, without relying on debt.
A huge strategic advantage, especially in such a dynamic market.
For sure.
But, okay, beyond those impressive financials, the real story here, it seems, is about a company facing this, tectonic shift in its industry and making a truly audacious move. Goldiam International, traditionally known for natural diamonds, seems to have embarked on a full-scale strategic pivot towards lab-grown diamond jewelry, LGDs.
Oh, absolutely. And the sources show just how fundamental this reorientation has been. In Q1 FY26, lab-grown diamond jewelry contributed an overwhelming 88% to their overall export revenue.
88%.
Yeah, and that's a massive jump from 68.4% just a year prior in Q1 FY25. This isn't just about, tweaking the product mix. It's a fundamental reorientation.
It sounds like they're really seizing a future where consumer values might be shifting towards, well, maybe sustainability, accessibility.
That's a big part of it, I think. It could potentially disrupt the entire luxury jewelry landscape.
And here's an interesting detail from the sources. The realizations, the prices they're getting for LGD jewelry continue to be at a premium compared to mined diamond jewelry for them, which is maybe counterintuitive to some.
It might seem so, but it's mainly because they're focusing on selling higher caratage pieces. So they're successfully targeting a more, let's say, lucrative segment of the LGD market.
Okay, that makes sense.
And their strategy also includes complete backward integration. Remember, they acquired an 88% stake in Eco-Friendly Diamonds LLP, or EDL. That gives them direct access to the raw materials for growing these lab diamonds.
Ah, so controlling the supply chain.
Exactly. Greater control and the ability to secure those raw materials at competitive prices, which is vital for keeping those margins healthy, as we saw.
And management themselves are saying this whole aggressive move into LGD reflects overwhelming customer preference and strong customer demand. What's also noteworthy is how they seem able to pass on additional tariffs to customers.
Right, which highlights their market position, doesn't it? Their ability to maintain profitability even with external cost pressures like tariffs.
Okay, so the LGD pivot is huge. But beyond that, Goldiam is also embracing an omni-channel sales strategy, meeting customers where they are. The sources show online sales accounted for a notable 20% of their revenue in Q1 FY26.
Yep, 20% online. And what's particularly clever, I think, especially when you consider their scale, is how they manage their inventory. The sources reveal that a huge chunk, 72% of their finished jewelry inventory as of June 2025, is actually held on consignment.
On consignment, so in their customer stores.
Exactly. The inventory is literally sitting on the retail shelves, ready for sale, but it's not weighing down Goldsman's own books.
That consignment model, that must minimize their direct inventory risks significantly.
It does. And it enables much faster inventory cycles compared to competitors who have to carry all that stock themselves.
It just sounds like a really smart way to manage assets and respond to market demand efficiently.
It really is smart.
And speaking of strategic growth, Goldiams isn't just focusing on exports, they're making a significant push into the domestic Indian retail market. That's with their new brand, Origem, right? Their exclusive LGD jewelry retail chain in India.
That's the one. As of Q1 FY26, they had 6 operational Origem stores, all in Mumbai. And collectively, those generated about $32.7 million in revenue during the quarter, which, interestingly, makes Origem the largest cocoa company-operated LGD jewelry retail brand in Mumbai already.
Wow, largest already with just 6 stores. And that Coco model gives them full control over the brand experience, the customer feedback.
Huge asset, yeah. Brand consistency, direct feedback loops.
And they're clearly not stopping there. The plans are much bigger.
Oh, yeah. They've already signed leases for 8 additional stores, including some really prime locations like Phoenix Mills in Lower Parel, Mumbai, and Phoenix Market City in Bengaluru.
Okay, so expanding beyond Mumbai.
Definitely. And the ambition is even bigger. The plan is to open 125 Origem stores in the next 24 to 36 months, expanding to Bangalore, Delhi NCR, Chandigarh. Quite an aggressive rollout.
100 to 125 stores in 2 to 3 years. That's ambitious.
It is. And they're also building out the online side with www.origimindia.com, strengthening that omni-channel presence. Management commented on the enthusiastic customer response in the existing stores. It seems to give them significant confidence in what they call the huge market acceptance for lab-grown diamond jewelry in India.
So strong belief in the domestic potential for LGDs.
Very strong belief.
Now, circling back to the financials for a moment, the sources paint a clear picture. Goldiam International is a debt-free company. In today's economic climate, that feels like a really powerful position to be in.
It absolutely is a key aspect of their financial resilience, especially when you couple that with their substantial cash and cash equivalents. As we said, over $2.7 billion as of June 2025. That gives them serious ammunition for future growth, maybe even inorganic growth like acquisitions, without the burden of interest payments.
Right. And for investors or anyone following the stock market, the company also seems committed to rewarding shareholders. They aim for a minimum payout ratio of 50% of their annual standalone PT, either through dividends or share buybacks.
That's right. And over the last 5 years, their average payout has actually been even higher, 65% of standalone PET. So they're exceeding their own target.
That commitment translates into real returns, too. The board recommended a final dividend of 1 per share for the last financial year.
Yep, for the year ending March 31st, 2025. And for those interested, the record date is September 19th, 2025, with payment expected around October 6th. It just shows a company that's confident in its cash generation and is, willing to share that success.
Okay, so looking forward then, what does the order book tell us?
It paints a pretty promising picture for near-term revenue. As of June 30, 2025, their order book position stood at about 1,400 million.
1.4 billion rupees.
Correct. And that includes new export orders specifically for LGD jewelry worth 800 million, which they received just in May 2025.
So a big chunk of recent orders.
Exactly. And this order book is expected to be executed within the next 3 to 4 months. So that provides good visibility on near-term revenue. And it's important to remember as well that e-commerce sales, because they're spot bookings, aren't part of this forward-looking order book.
Ah, so actual sales could potentially be even higher than what the order book suggests.
Potentially, yes.
And what's the commentary from management? What's their outlook?
Well, Executive Chairman Rashesh Bhansali pointed to the buoyancy in demand for lab-grown diamond jewelry in the U.S. as a key reason for their better-than-expected Q1. And Managing Director Anmol Bhansali expressed confidence in seeing robust demand for lab-grown diamond jewelry in India as well in the coming years.
So bullish on both fronts, U.S. exports and Indian domestic market.
That seems to be the view. It really highlights their dual market strategy. Their long-term vision seems clear, become the top vendor partner for the U.S. retail industry while also building this branded distribution network in India. Their whole journey, starting way back in 1986 and evolving through acquisitions like EDL, it shows this constant drive for value addition and market leadership.
So let's try and wrap this up. What does this all really mean? Our deep dive into Goldiam International's Q1 FY26 results, it seems to reveal a company that's not just reporting strong numbers, but is actively fundamentally reshaping its business model in response to these huge market shifts. From that massive pivot to lab-grown diamonds to the aggressive domestic retail expansion with Origem, it feels like a masterclass in adaptability.
I agree. It's a really compelling example of how a company can leverage, market responsiveness, smart acquisitions, and an omni-channel approach to achieve pretty significant growth, especially in what's often seen as a traditional, maybe even conservative industry. Their ability to manage costs, pass on tariffs, stay debt-free, and maintain that robust financial position despite industry headwinds. It really speaks volumes about their operational strength and their strategic foresight.
It certainly does. It's clear that Goldiam International's story shows us how innovation and strategic agility can really redefine success. They haven't just adapted to change, it feels like they're actually driving it in some ways. Okay, so now something for you, our listener, to mull over. With lab-grown alternatives gaining such strong acceptance in jewelry, where else might we see this happen? What other traditional industries might be, well, ripe for disruption by lab-grown or synthetic alternative? Could we see this trend extend to materials in, say, fashion or construction, maybe even food? And what kinds of opportunities or indeed challenges might that create for businesses and for us as consumers? Something to think about.